Hello and welcome to Fluky Facts. Today we are going to understand one of the most important and commonly asked concepts in economics, which is inflation. You might have noticed how price of goods like milk, vegetables or petrol keep rising over the time. Sometimes slowly, sometimes sharply. That rise in prices and the fall in the purchasing power of your money is what we call inflation. In this video, we will explore what inflation actually means, how it's measured, the type of inflations, and major causes behind it, especially in the Indian context. Let's get started. Inflation simply means a general increase in the prices of goods and services in an economy over a period of time. It's not just one or two items becoming expensive. It's when prices rise across most items we use daily, such as food, fuel, clothes, transport, rent, and so on. When inflation rises, the value of money falls. For example, if 100 rupees could buy you 10 apples last year but only 8 apples this year, your money has lost its value. That's inflation in action. A small amount of inflation is normal and even good. It encourages spending and investment. But when inflation becomes too high or unpredictable, it affects the entire economy. Let's take a simple example. Imagine a liter of milk cost 50 rupees last year and this year it costs 55 rupees. That's a 10% rise in price or 10% inflation in milk. Now, if similar price increases happen in most of other products like rice, fuel, and vegetables, that's general inflation. In simple words, inflation makes things costlier and reduce your purchasing power. This is why economists and policymakers constantly monitor inflation because it directly affects our daily life, savings, and financial stability. Inflation is measured through price indices, tools that track how the price of a selected basket of goods changes over time. The three main indices are Consumer Price Index, Wholesale Price Index, and GDP deflator. CPI or Consumer Price Index measures what consumers pay for goods and services like groceries, fuel, rent, etc. WPI or Wholesale Price Index measures inflation at the wholesale or bulk level, and GDP deflator reflects price changes across the entire economy. In India, CPI is the main measure used by the RBI or Reserve Bank of India for policy decisions. The RBI's inflation target is 4% plus or minus 2%, meaning it's comfortable if inflation stay between 2% to 6%. Inflation can be classified by how fast price rises. Creeping inflation, a slow, steady rise, usually below 3% per year. It's healthy for growth. Working inflation, moderate between 3 to 10%, still manageable. Running inflation, rapid price increases 10 to 20%, economy becomes unstable. Hyperinflation, extremely high and uncontrolled inflation, like what Germany faced in 1920s or Zimbabwe in 2000s. For growing economies like India, moderate inflation around 4% is considered healthy. Economists usually explain inflation through two main causes, demand pull inflation and cost push inflation. In demand pull inflation, when demand in the economy grows faster than supply, think of festival season. People buy more, but supply can't keep up, so prices rise. In short, too much money chasing too few goods. In cost push inflation, when production cost increases, for example, when fuel price rises, transportation cost goes up, and producers passes the cost to the consumers. So even if demand doesn't change, prices increases because production becomes costlier. Both types often occur together, making inflation a tricky problem to manage. There are some other forms worth knowing. Imported inflation, structural inflation, wage price spiral. When the price of imported goods rises like crude oil, it pushes domestic prices up. In structural inflation happens due to long-term supply issues like lack of storage or transportation facility. When rising wages lead to higher production costs, which then cause higher prices and in turn demand for even higher wages. This is called wage price spiral. This shows that inflation is not just about money. It's linked to the structure and productivity of the economy itself. Let's now look at the key causes of inflation in India. Increasing in money supply. When too much money is available in the system, people spend more pushing prices up. Fiscal deficit. When the government borrows heavily to fund expenditure, it increases liquidity and demand. Rising input cost, fuel, electricity, and raw material costs directly raise the price of finished goods. Supply chain disruption, poor harvest, natural disasters, or global events like wars can limit supply. And finally, global factors. Crude oil prices changes, currency depreciation, or geopolitical tension can all trigger inflation. In short, inflation can be caused both by too much demand or too little supply. Inflation affects everyone, individuals, business, and the government. How? Purchasing power falls. The same money buys fewer goods. If inflation is 6%, but your bank gives 4% interest, you are actually losing money. Hence, there is a depreciation in your value of your daily essentials becomes expensive for middle and lower income families. But sometimes inflation can be benefit to the borrowers because they repay loans with money that worth less. Investors face uncertainty. Business struggle to plan long term. So while mild inflation is manageable, persistent high inflation reduces confidence and economic growth. The Reserve Bank of India plays a key role in managing inflation through its monetary policy. It uses repo rate, reverse repo rate, CRR, and SLR to regulate or to tackle the inflation. So, what are these? Repo rate, the rate at which RBI lends to commercial banks. When inflation rises, RBI increases this rate to make borrowing costlier and reduce demand. In case of reverse repo rate, the rate at which RBI took deposits or the surplus amount of commercial banks have so that it can manage and regulate liquidity in the market. CRR and SLR, RBI uses cash reserve ratio and statutory liquidity ratio to reduce the money supply in the open market. By adjusting these rates, RBI ensures that inflation stays within the target range while supporting economic growth. The government supports the RBI by using fiscal policy tools like controlling spending, subsidies, and taxation. It can release buffer food stocks to control food inflation, reduce import duties on essential goods when prices rise globally, offer targeted subsidies to reduce the impact on the poor. Together, the RBI and the government work maintain price stability and economic balances. In recent years, India's inflation has mostly remained moderate, between 4% to 6%. However, there have been spikes during the COVID-19 pandemic due to supply chain disruption. In 2022, after the Russia-Ukraine conflict, global oil prices rose sharply, which causes rise in inflation. Food prices also fluctuate due to seasonal and climatic changes. The RBI continues to adjust policy rates, control inflation while promoting economic recovery. To sum up, inflation is not always a bad thing, but it needs to be balanced. Some inflation is a sign of a growing economy. It encourages people to spend and invest, but when inflation rises too fast, it eats into savings, disrupts planning, and hurts the poor the most. Managing inflation is like balancing on a rope. The goal is price stability with sustained growth, and that's exactly what the RBI and the government work toward. Before we wrap up, here's a question for the UPSC aspirants. What is inflation? Explain its types and major causes in the Indian context. If you found this video helpful, please like, share, and subscribe to Fluky Facts. We simplify complex topics, finance, polity, economy, and science for everyone.